Hi guys. Today we will analyze Exxon Mobil stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a good performer in the overall market. The long and short-term trends are both positive. Strong support levels are around $88.50 and $82.30. Next strong support levels are around $66 and $55. The stock is at all-time highs, which means there is no resistance level just above it. It's too risky to buy the stock at these levels. In the last month the stock has been trading between $83.40 and $97.40 range. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 30 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 11% per year, for last 5 years. We see that the average profit margin of the stock has been around 3% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 72% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Exxon Mobil Company: bad, average, and good. First scenario. Exxon Mobil will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, -3%. Future profit margin would be low, 4%. Future free cash flow to net income rate would be low, 60%. In this case, the fair value of the stock today would be $32. Second scenario. Exxon Mobil will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 0%. Future profit margin would be average, 5%. Future free cash flow to net income rate would be average, 70%. In this case, the fair value of the stock today would be $48. Third scenario. Exxon Mobil will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 3%. Future profit margin would be high, 6%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $69. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 6.02. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Exxon Mobil, analysts forecast growth rate around -3% per year in next 5 years, and future P/E around 10. Again, I will use 3 different scenarios for Exxon Mobil Company: bad, average, and good. First scenario. Exxon Mobil will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, -3%. Future P/E would be low, 14. In this case, the fair value of the stock today would be $27. Second scenario. Exxon Mobil will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 0%. Future PE would be average, 16. In this case, the fair value of the stock today would be $41. Third scenario. Exxon Mobil will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 3%. Future PE would be high, 18. In this case, the fair value of the stock today would be $60. As you can see, today the stock is overvalued, $96, even if we expect the company's high performance in future. Exxon is one of the best oil companies with an impressive portfolio of assets, but the revenue is expected to decrease by -3 to 5% on average over the next 5 years. And the stock is currently too overpriced. Also, the stock is at all-time highs. It's too risky to buy the stock at current levels. I own the stock, my cost basis was $57, but I have sold it recently. I would be happy to buy the stock again, when the stock drops to $60. Company's strengths. Exxon Mobil is an American multinational oil and gas corporation. It's one of the largest companies in the world, and the largest oil company in the U.S. It operates globally along the entire hydrocarbon value chain, from energy exploration to end-user product sales and marketing. The company will benefit from strong energy market fundamentals, as well as from its improving balance sheet, reduced capital spending, and higher free cash flow. Exxon will see its portfolio mix shift to liquids pricing, as gas volumes decline and new oil projects start production. Cash margins should improve as a result, thanks to Permian and Guyana volumes. Exxon has responded to shareholder concerns by reducing spending, appointing new board members, and increasing disclosure. The company is also taking steps to address climate change, and continues to target net zero greenhouse gas emissions by 2050. Exxon is a dividend aristocrat. It increased its dividend for 40 consecutive years. With a yearly dividend yield of 3.64%, the stock has a good dividend return. Exxon has a return on assets of 7%. This is better than the industry average of 4%. Exxon has a return on equity of 15% and profit margin of 8%. This is comparable to the industry average. Risks. The company is exposed to volatile, cyclical, and capital-intensive segments of the energy sector. Investors in Exxon shares are exposed to numerous risks, including trends in energy prices, interest rates, and global economic growth. Exxon also operates in some countries with a history of official corruption, and in others that are prone to political upheavals, for example Nigeria. Despite activist pressure and new board members, Exxon has not sufficiently reduced investment levels and continues to develop long-life projects that hold a high risk of becoming stranded. Exxon lacks the level of investment in low-carbon businesses, such as renewable power. Returns are unlikely to ever reach historical levels without higher commodity prices, potentially resulting in compression of Exxon's premium multiple. Oil spills are a never-present risk for oil companies operating offshore, and can be devastating to a firm's value. Environmental, social and governance-related risks include changes in policy related to climate change, such as a carbon tax, that could result in higher costs, reduced demand, or stranded resources. Greater adoption of electric vehicles in the U.S. and Europe could threaten the long-term viability of Exxon's downstream assets. Exxon is expected to show a decrease in revenue. In the coming 5 years, the revenue will decrease by -3 to 5% yearly. Based on estimates for the next 5 years, the company will show a small growth in earnings per share. The EPS will grow by 1 to 5% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.